Hello, everybody. Welcome to Wall Street Hackers. My name is Nick Palavito. I'll be your moderator for today's show. And today we have a very exciting show because there's been changes in the stock market, and especially with interest rates. And so we're having a wild day. And with that, we're going to bring in the hacker himself, who graduated from UCLA with a degree in economics, a master's degree from NYU, and also a law degree from the University of Miami, spending 17 years in the Wall Street area. We're going to bring in Peter Bennett, and also our co-panelist, who's our co-moderator on the show, who's the president of the Pod TV network, Kim Calhoun. So she's going to join us as she's working diligently in the background to get everything prepared. But with that, with no further ado, since we're going to have him do a lot of work for us right now, let's bring in the hacker himself, Peter Bennett, the hacker himself. Peter.
Hi, Nick.
Take it away.
Hi, Peter. Welcome back.
Yeah, we've been back from our 2-week break and ready to go. Of course, the markets are always moving quickly, and there's so much to talk about. You can always catch us on starting Thursdays almost every week, and we rarely take breaks. And and Pod TV, by the way, podtv.tv is the new way to catch us. So first, the markets. We begin with our chart of our show basically now. Kim, if you can bring it up. If you can't, I'll just hold it up. I'll hold it up for now. This is such an important chart because it shows the thesis of our show. It's that dividend growers and initiators do so much better than dividend payers, and dividend payers do so much better than the S&P 500. So if you look at if you can bring at least
a couple people exiting stage right.
So the point is, if you had $100 invested in 1973, if you put it into dividend growers and initiators, by 2022 you'd have 13,000 and change. If you put it into dividend payers, you'd have 8,000 and change. If you put it in the S&P 500, you'd still do well, 4,000 and change. Although I don't think the S&P is going to do as well going forward, because during that period, interest rates fell and fell, which stimulated the market. So bottom line, safe dividend growers and energy are the way to be right now. So the markets in general, first, as expected, I knew it was going to happen, but so many people move that way. The Fed raised 0.25% on their rates to 5 and 5 to 5 and 5 and a quarter. But the market seems to ignore this was the 10th consecutive rate increase. The Fed was behind for a year, the curve. Now they're increasing steadily, and the market's still pricing in decreases by the end of the year. I think it's almost impossible for decreases. I mean, maybe they'll stop at some point, but the evidence is strong that the market is delusional, as it has been. It went down a lot. Now it's been flat for a year, up and down, but I think it's set to decline because we're almost certainly in a recession in the coming future. I mean, that's the bad news, but you can adjust through the right stocks, as defensive stocks, buying income. There's ways around this. So why is the market delusional? First of all, look at the short-term evidence, and then we'll look at the long-term evidence. Inflation is so far from under control again. The Fed's target is 2%. Well, the Fed's favorite measure is core CPI. It's at 5.6%. Services inflation, which the Fed considers very important, is at 7.3%. The 25-year high just 2 months ago or so was 7.6%. So we're just off the high. Now, the market's been thinking, okay, inflation's dropped a little bit, and it has a little, but nowhere near the 2% target. But wage growth is up 5.1% year over year. And the key factor is that inflation slowed a little bit, largely because of energy prices. But energy is not in a long-term bear. I don't think so, because one, we had a very warm winter in most of the developed world, and two, because of China's temporary shutdown. These are very temporary things. Now we're heading into driving season. So if it's not this year, next year, energy's going back up almost certainly because energy companies are putting in 40% too little capital to even maintain production where it is. So energy is not going to be the answer. It's going to be part of the problem. Then look at the long-term evidence. Despite 10 corrective rate increases, the Fed is still below inflation. You have 50 years of history that shows that every time the Fed is below the rate of inflation, they need to raise it to inflation or above inflation to get inflation under control. Another long-term study, 16 countries over 50 years, inflation, when inflation gets over 5%, it takes an average of 10.1 years to get it under control. We're only in not even the second year yet, including the second year. It's never happened. And another study says that every single time inflation gets over 4% and unemployment is less than 5%, there is a recession. Now, the market's pricing in 63%, which is a decent chance. I think it's about 100. But that's because you'd emphasize 3 points. One, inflation is much higher than 4%. And every time it was meeting those parameters, it was a recession. Number two, unemployment is much lower than 5%, somewhere around 3.5. So these conditions aren't just met, they're easily met. And the bottom line is it happens every time. So if you look at history, it points to the fact that we are a ways to go. And the Fed will probably keep raising rates, even though it's saying it's, quote, data dependent. But the data is not probably going to be good. Also, another note, interesting area is real estate markets. Wall Street Hackers said a year and a half ago the commercial markets are going to crash. And very few people at that time were saying that. I was saying, why aren't other people talking about this? I heard one story about it, but I could see it. And now it's starting to come to fruition. So that's because, one, U.S. office occupancy rate is only 50% now. It means between people who aren't in the office or people working part-time, there's huge vacancy rate, 50%. Right now, today, 16.9% of office space is vacant in the United States. And I'm sure the situation is similar in the world. I know it is. And also, it's increasing from 16.9% of just vacant. And finally, defaults on commercial office buildings have been rising at a pretty decent pace. So this is why you have to be very careful about certain investments. One, office REITs off the table. I keep looking at one. I'm waiting till things at least clear up a little bit. But number two, storage REITs. Very easy to convert an office REIT relatively to a storage REIT. I actually know somebody who works in an approval type process for a county, and he says he's been getting a lot of applications to convert offices into storage REITs, and that alone should scare anybody in a storage REIT. And number three, you have to be very careful about medical office REITs because the same thing, and even apartment REITs, you have to be extremely selective because what's going to happen is some of these offices are going to be converted to apartments too. But that's more expensive, but it's going to happen and it's going to influence all the markets. It's a huge change. Quotes of the week. Number one from Barron's last Sunday. As the Central Bank Policies Committee gears up for its May 3rd meeting and what is widely expected to be a 10th rate hike, it did have the 10th rate hike, it will be embarking on a new and more volatile phase in the tightening cycle, marked by far less clarity than what has come before. The risk of misstep is growing, and the consequences of over or under shooting would be severe. Well, I think they've already undershot, and they're way behind the curve. And I don't think there's any scenario where they win at this point because it takes a recession to slow inflation, at least historically, and they're behind the curve still. Vice Chairman Berkshire Hathaway, Charlie Munger, said the U.S. commercial property market is in trouble with American banks full of bad loans as property prices fall. I've stayed away from banks also. I forgot to mention that for the last year and a half, partly because of that. A lot of banks have a lot of exposure. There's probably some that will slip through fine, but why do I need the risk when there's great opportunities? Number 3, Chairman Powell said that his latest rate hikes are not necessarily sufficient, and that, quote, it's an ongoing assessment. And that's right. It's data dependent. They're always looking at the data. But I don't see a lot of data that favors it, from this hopeful market, delusional market perspective. 5 most interesting stories of the week. The U.S. is the only country in the developed world with open borders. It is out of control. Every other country is controlling its borders and decides, do they want a citizen in? Will they be productive? The United States just leaves it open. The White House said this week, the spokesman for the White House said, quote, when it comes to illegal immigration, you've seen it come down by more than 90%. It's insane for them to have said that. And they repeated it. It's the reality. Enforcement encounters at the border just in March alone were 192,000. That's the ones that they encountered, not counting people who slipped in. It's a situation out of control. Number 2, interesting story. Americans spent $30 billion on legal marijuana in 2022, much higher than the $20 billion spent on chocolate. I'm guessing most consumers don't know the study that Wall Street Hackers recently cited that said that coronary heart issues can be caused by daily or significant marijuana use. It's very significant, that danger. Nobody's really talking about it, but it's a big change in perspective on marijuana. A female volleyball player suffered a concussion and severe neck injury when a transgender spiked a ball into her head. The Democratic Party is likely out of touch on this issue with the populist thought, and it's probably going to hurt them in the 2024 election. Their perspectives on crime are not popular, and I only blame the media for supporting every position they take and never criticizing them. And I think they're out of touch with reality. We'll see. I was surprised to find that India surpassed China in population for the first time, and is now the world's most populous country at 1.4 billion. That doesn't count Hong Kong and Shanghai. A few other issues in India. One, they recently passed regulations that allowed the government, quote, Press Information Bureau to block any online misinformation. I think that's shocking. And they banned a documentary critical of Prime Minister Modi, and even arrested a college student who was going to show the film. So it's a little worrisome what's going on in terms of suppression of information. Number 5, interesting story. New York is passing a ban on all gas hookups after 2026. Another crazy policy. They're going to rely on heat pumps instead of gas. But the problem is, in colder parts of the state, heat pumps will not be sufficient during the winter to heat the houses. But this is the plan. And not only that, using the heat pumps will draw a lot more electricity. And along with EV usage, they're very likely going to be blackouts in New York because of insufficient power. So it's just poor planning. I wish I try to end on a happy story, but after the weeks, these were important stories to mention. So let's take a quick break, and then we better keep moving because we've got the dividend pick of the week and our panel discussion. We'll be right back.
One of the things that business owners forget a lot is to prepare for their own retirement.
Hi, my name's Nick Palavita, and today I'm with a very special guest, a certified financial planner, a chartered retirement plan specialist, and president of National Pension Partners, Max Couliet. Max, tell me what you do at National Pension Partners.
Well, Nick, we help successful small businesses and professionals put together retirement plans that provide them the maximum retirement benefits and big tax deductions at the same time.
Well, how do you do this?
Well, we get on an internet conferencing system with the client. We review their goals, what they want to accomplish, and then put together strategies to help them in implementing a retirement plan that benefits them, not everybody else.
Well, that sounds really good, but how much does this cost?
Well, it's really not bad because the first consultation is free. That allows us to go through and discover whether this strategy works for that business and for you as the business owner and helping you maximize your retirement.
Well, Max, how do we get this free appointment?
It's really pretty simple, Nick. You can either go to our website below or call us at 877-252-1692, and then we can set up a time with either myself, Nick, or one of our other retirement plan specialists, another CPA or advisor in the office, to go over this with you and make sure it fits for you.
Hi, my name is Lewis Haupt. I work with National Pension Partners, and I work with businesses to allow them to put the maximum away that they can for themselves and to save taxes.
Hi, I'm Brad Coyle, and I'm the brokerage manager at National Pension Partners. We're always analyzing plan fund choices in order to ensure the participant's success.
If you want more information on how we can help you and your business put more money away in a retirement plan than you ever thought possible, contact us at the website below or call us at 877-252.
Hi. So what to do, as always, look at the first chart. I mean, you have to own, or you should own, strong defensive dividend stocks, ideally with growing dividends, especially MLPs and energy stocks with high dividends. And you need to lock in income because we're in two phases. Phase one is now, and inflation's the problem. But in the next coming years, the governments of the world are going to use what's called yield curve control. You can look it up, to drop interest rates down to zero because they won't be able to afford the interest on the debt. So they're going to control it. They've done it before. They'll do it again. So you have to lock in long-term income, whether it's long-term bonds, long-term dividend stocks. So the dividend stock of the week is another MLP. I love the MLP pipelines, but first I have to discuss my portfolio and things I've said over the show because I had to make some changes. Energy became 33, maybe 34% of my portfolio. It's just too much. I wanted to drop it down to 24%, which is still considered very aggressive. But so I sold some MPLX from 18% down to 15%. I bought EPD, which we'll be discussing in a minute, up to 4.5%. That's Energy Product Partners. I also recently recommended Woodside Petroleum only for a very small 0.5% allocation. Well, Australia's looking at a huge petroleum tax, resource tax. I said, forget it. I'm dropping energy. That'll be the first to go. I don't need to deal with that. I took some small loss in that, but very small. I sold BSM from 6% down to 1.5%. Just that was the one to go because it was subject to commodity prices. Probably do very well, especially since it has no debt. So it's always going to generate income. But something had to go, and I love the defensive pipelines. Why do I love pipelines? One, they have long-term contracts. They have high interest rates. The histories are huge on their growth. In a lot of years, they grew 17% a year. They also, when they talk about that high cash flow, that doesn't even count the projects they're doing. So that increases the cash flow even more. There's a lot of safety. In my opinion, utility like safety with those kind of yields. I'll take it every day. Also, I mentioned ODC a while ago. It was only a 7% allocation, but it was up like 28% in 4 months, which was very good. And so I decided the dividend was too low at that point. I just sold that. Hold on one second. Okay, so now EPDLP, as I said, it's an energy pipeline. They're demand oriented, so they fluctuate with oil prices and gas prices, but it's ridiculous because they shouldn't. I brought it up to 4.5% of portfolio because I had money because I sold several of the others down a bit. It has a 7.5% dividend, but a great dividend growth history and cash flow. The cash flow is price over cash flow is 7.3, so it has a 14% cash flow yield. So, but the thing is, again, when you look at the cash flow yield, it's making 14% in free cash in cash flow yield, but that doesn't count the $2 billion they're putting into projects, which are going to create growth. So if things got really bad, they could take that $2 billion and say, okay, we're going to stop growing now. And that would even more support the dividend or dividend growth or buybacks, which these companies do. Its 5-year annualized revenue growth is 15% a year. And in 2012, its dividend was $1.27. In 2023, $1.96. So I'll take that every day, that kind of $1.27, $1.96 in 11 years with a 7.5% starting dividend. And, it's the closest to MPLX I could find, basically, when I didn't want to own over 20% in MPLX. Okay, Panel discussion of the week. Is AI, artificial intelligence, a positive or negative for the world? Just quick background. One, AI recently created a totally artificial advertisement using artificial people and an artificial barbecue. It's amazing what AI can do. Another story, people were baffled by photos of Donald Trump being aggressively arrested in New York City by the police department, and also of the Pope, who was wearing a very luxurious coat. Only problem is they were totally fake photos, and they were designed by AI. So AI now can create artificial sounds, artificial. You start wondering what reality is. The World Economic Forum just came out with a forecast that the world will lose 27 million jobs by 2028 due to technology and AI. And that's in a world that normally needs to keep growing jobs for growing population and growing economies. The CEO of IBM just said the company will likely now freeze all hiring because he said so many jobs can be done by AI in the next few years. And Elon Musk said that even the world has to be concerned about a benign, quote, benign dependency on AI, which can threaten civilization. So if you look at history, though, usually technology has helped mankind. I mean, mankind's lifestyle, everything is so much better than it was in the past. Everybody knows that. But the question for the panel is AI, artificial intelligence, going to be a positive or a negative for the world? Nick and Kim?
You go on, but I have my opinions. Go on, Kim.
Oh, well, first, I think the IBM CEO is a complete idiot for making that kind of statement, because who creates a technology to replace themselves? I mean, I hope they replace him with technology, or her, because that was a complete idiotic statement. But AI was not intended.
I don't think he's saying AI is going to replace the CEO. That's going to be one of the last.
Well, you know what? They should, because AI was not intended to replace HI, human intelligence, because we created. Also, the data used for AI is what? Created by human intelligence. They collect our results, our outcomes, and compile them. But I think artificial intelligence is very important for our future. We just need to learn how to use it to enhance our capabilities and abilities. And that's what it was intended to be used for. But if you're going to sit there and continue replacing people, eventually we're going to have the Matrix situation or Skylabs, and it's going to.
Well, these are dangers. That's right.
Oh, and Peter, I want to share a new news story about science. Okay. Artificial intelligence is robots as well, right? And now they have been able to get women pregnant using a robot with artificial intelligence and a PlayStation, a video game. Wow. Yeah, so they use the video game.
The world gets stranger and stranger.
Right, and that's how they get women pregnant. So, it's getting a little out of hand, if you ask me. Yeah. I think, we just need to utilize it to enhance our quality of life, not to replace it. But Nick, what's your thoughts?
Well, it's way overrated. All the arguments you see. Okay, and I'll tell you why. First of all, I've heard the media talk about, it's going to hurt. Give me one example. They can't give one example. Okay, come on. I can actually give you some examples where it has been used in chess, because the chess players have been following this for years. And we know the top programs out there like Stockfish, Deep Blue, etc. Now, you could take a position. This is one reason the people who talk about this don't know what they're talking about. The best chess players in the world today are computers. Oh, that means all the chess players are going to be out of business because people. No, that's not what happened. Do you know what happened, Peter? Chess players today make more money than they ever did. Ever. Do you know why? Because people like watching speed chess being played on the internet. I'm not kidding. And on Twitch. And they have developed huge amounts of followers, and they get huge amounts of advertisers. The chess players today make more money than they ever did. I had 2 students that became professional players because of the expanding market. Now, what did Stockfish do? It's the best program for computers in the world, and Deep Blue. Nothing. They're great computer programs, but they didn't replace any jobs. It didn't even happen. It wasn't even close. What you really see is a media that's so stupid they don't understand that nothing's happening. They really don't.
So I'm going to take the opposite position.
Well, I would like to give me one argument. I heard you.
No, I'm going to give you a couple of
arguments. One
arguments.
argument that makes it bad.
So here's the point. First of all, people look at the past and they say, okay, technology has not hurt people. I mean, the gas light. They replaced the gas light and they said, oh, jobs will be lost. And then they brought in electricity. But this is the first time that we're bringing in technologies that not only can think in many ways far superior than people, in many ways, not always, but also robots that can physically do everything a person does. So wait a minute. People can, it's going to help business, by the way. It will help certain businesses as a side because they're going to employ these. But the problem is who's going to be the buyers? So to cite a few points, McKinsey, I love McKinsey. I came across them in my Wall Street career. They actually were talking to me a little bit about a potential job there. And that's when I found out they were consulting at Citibank Investment Bank. And McKinsey is really sharp people. They are forecasting that 400 million jobs worldwide could be lost by 2030. And I go, well, wait a minute, 400 million jobs, but what about 2035, 2040? These technologies are amazing. Right now, I'll give you two examples of where it's going to be really concrete. Driverless cars are, and I think they're underestimating eventually for sure. Driverless cars are 9% of all jobs in the United States. Driver cars are 9%, not counting trucks, which are another 2%. And in the world, there's so many taxi drivers, limo drivers. You know what? Driverless cars, as soon as they get in, these driverless these Ubers and companies are going to say, okay, we can get rid of our staff and cut our costs, and that'll change things. But also, look at when you call, so many companies, these machines are getting smarter and smarter. They sound like people. And then Amazon has robots stocking their warehouses and other stores. So this is coming. I think people are underestimating the danger of it, but in terms of the changes for society, some people will thrive, but many people and the economy are going to be stretched when there aren't enough jobs. And I've heard the argument, well, somebody has to make the robots, but guess what? The robots will be making the robots, and they can do it. And the other concerns are the obvious, as Kim mentioned, the war game type scenarios. Are they going to be in control and making decisions? You'd think human element will always be there, but AI can think for itself. And who knows what they'll do. And the only positive I see mostly negatives, is that people are going to become more and more skeptical of information, because now you see that it's bad enough. The news media is so slanted. Next week I'm going to discuss this. There was major news that was admittedly against Biden, but you watch CNN and MSNBC for the first 15 minutes, and they were talking about the most ridiculous stories. A shooting in Atlanta for 15 minutes. It's like, but Biden, a major whistleblower, just said something about Biden taking bribery. You might want to mention it, but the point is, in Fox News, I don't agree with a lot, but at least they try to report both sides. But it's such a slanted thing, so people have to become skeptical. You don't like Fox News, obviously, but you know what? If you watched it, actually,
they're one-sided.
No, I don't think so. But let me put it this way: they do put on both sides, but they are slanted. Let me put it that way. But the point is, they are definitely slanted, and I don't agree with all their positions. But they don't not report stories, even a positive story. They'll just. Most of the media will not even mention it if they don't like it.
But Peter, they just lost a lawsuit for lying.
I know.
It wasn't a small
lies.
That would be another show, and they may have been wrong on that issue.
Show, but Peter, when you talk about AI,
wait, let me make my main point. My main point is people need to be skeptical of all media, which is that. And now, if you know that everything on you're watching could be fake, it could be a fake person, a fake voice. We're in the information age, but people have to learn to think for themselves more, and that will be a positive. But there are great economic issues with AI, and a lot of people are concerned about it.
Well, see, the thing is, your arguments about job displacements. I remember reading about this automobile coming in, and you know what? The American Express company was going, we ain't going to be able to use our horses anymore because they got trains and automobiles. And the blacksmith was going, I'm out of a job. There's nothing I can do.
agree historically.
But you know what happened? Whole new industries.
Yeah, you know what? We're going to have to continue this. I think we will.
I just don't buy into this fear.
We'll discuss. We'll continue this next week.
Just
we're pretty much out of time. But
I agree.
you know what? But let me say again, my point is, this is different. It's not gaslight or horses. This is the first time that technology is replacing the human brain and the human body. That's different than just replacing a horse. So we will see, in the future. But this is a discussion that will continue next week, and also see if there's even any slowing it down. Because is there a way to slow it down? The future marches on. Anyway, as Kim always says, get healthy and get wealthy. And we'll see you next week regularly now for quite a while on Thursdays, starting on Thursdays. And have a great week.
Take care.
Kim.